Coeur d'Alene's industrial vacancy rate is sitting comfortably at 6.9% right now. But a sudden massive drop in new construction has national buyers quietly buying up the market right out from under local owners.
Yeah, it's a profound structural shift. We're really watching a market undergo a massive institutionalization, and it's kind of disguised behind what looks like a relatively quiet quarter on the surface.
Welcome to the Deep Dive. Today we are focusing entirely on the Q2 2026 industrial market in Coeur d'Alene, or as we'll be calling it for the rest of our time together, CDA.
Right.
Often, when outside capital looks at this region, their eyes naturally drift west toward the neighboring market of Spokane,
Right.
looking at that larger industrial footprint. But today, our focus is zeroed in completely on the heart of Codogny County.
Exactly, because, the disparity between that surface level stability and the really aggressive capital movement underneath, it's probably the most compelling narrative in regional real estate right now.
We're looking at what makes this specific market tick, the underlying mechanics of its supply constraints, and why out-of-state capital is suddenly just so aggressive here.
Yeah.
All figures cited today are from the Q2 2026 market report, utilizing data provided by Activate Real Estate and CoStar. Our mission is to extract the critical insights from this data and explain exactly how it impacts investment strategies moving forward.
And, it is definitely a quarter where having a custom breakdown is going to separate the proactive owners from the reactive ones.
Absolutely. And we're going to do all of this in under 20 minutes. For those of you who want to take this a step further and map these metrics directly onto your own portfolio, your point of contact is Eric Peterson. You can reach him at 509-903-9077. Give him a call for a custom market breakdown.
Highly recommend that, yeah.
Let's start with a high-level snapshot of the quarter just to establish our baseline before we get into the heavy analysis. Give us the rapid-fire headlines on the ground in CDA right now.
Sure. So I'll give you 4 key metrics that set the stage here. First, on the demand and supply side, that vacancy rate we mentioned is sitting at 6.9%.
Okay.
And that is practically unchanged, like a tiny negative 0.1% shift over the trailing 12 months.
So basically flat.
Right. We saw 57,000 square feet of net absorption pushing against 45,000 square feet of new deliveries. So very balanced.
All suspiciously balanced, honestly, which brings us to the forward pipeline.
Yeah, that's the second metric. The construction pipeline has effectively evaporated.
Wow.
There is only 48,000 square feet currently underway. And when you consider that the 10-year average for this market is 260,000 square feet.
Oh, wow.
Yeah, you realize we're operating at a fraction of historical capacity.
Right.
Third metric is pricing. So CDA remains a massive value play. The blended market pricing is estimated at $114 per square foot.
Okay, and nationally?
The national average right now is sitting way up at $160 per square foot.
Which feeds directly into your final baseline metric, the yield.
Exactly. The capital markets are showing a local cap rate yielding 8.6%.
Okay.
Compare that to the 7.3% national average.
Wow.
So if you remember one thing from this entire breakdown, let it be this. While current vacancy looks a bit, elevated compared to historical lows, the complete halt in new construction is creating this pressure cooker that national investors are already moving to exploit.
A pressure cooker. I mean, that 48,000 square foot pipeline figure really is the linchpin of this entire report.
Oh, totally.
A 10-year average of 260,000 down to 48,000 isn't just a slowdown. It's a dead stop.
Right.
In the stock market, you'd call this the setup for a short squeeze.
The short squeeze analogy is incredibly apt here.
Because it's like someone turned off the faucet, but the bathtub is still draining, right?
Okay.
You have steady, ongoing demand, represented by that 57,000 square feet of trailing absorption. But the new supply has been choked off entirely. Once that existing 770,000 square feet of available space gets soaked up, there's no relief valve.
Exactly. And you have to look at the mechanics of why that supply valve was shut off in the first place.
Right.
It isn't a lack of developer interest or like a bearish outlook on Coeur County. It is pure development mathematics.
The costs.
Yeah, the cost of capital, the elevated prices for construction materials, the persistent labor premiums. They've all made new development incredibly difficult to pencil out. The yield on cost for a ground-up project simply does not justify the risk at current market rents.
So developers are essentially paralyzed by the spread between construction costs and what they can reasonably expect to lease the building for upon delivery.
Exactly. Which violently shifts the leverage to existing asset owners.
Makes sense.
Because over the last couple of years, as that 6.9% vacancy accumulated, tenants actually enjoyed a brief window of optionality.
Right. If a landlord got too aggressive on a lease renewal, the tenant could just threaten to move down the street to a new block of space.
Exactly. But with the pipeline drying up, that optionality is just disappearing.
Which means we are staring down the barrel of significant rent growth.
No, absolutely.
Like if I'm an owner holding a functional asset right now, I'm looking at my rent roll and realizing that in, say, 12 to 24 months, my tenants will literally have nowhere else to go.
And that expectation of outsized rent growth is exactly why we're seeing the capital flow that we are. Because if local developers are sidelined by construction costs, you would assume institutional capital is as well.
Right.
But outside capital isn't looking at the cost to build. They're looking at the cost to acquire existing inventory.
And this is where that $114 per square foot valuation becomes the star of the show.
Yeah, it is.
Because the spread between CDA and the rest of the country is staggering. Let's dig into that affordability and yield advantage. We're talking about $114 a foot locally versus $160 nationally.
And if we break that CDA average down by subtype, it's logistics is sitting at $119 per square foot. Flex space is at $124, and specialized industrial is at $95. Yeah, so at those levels, you're essentially buying real estate at a 30 to 40% discount relative to the national average.
But you have to look at the yield attached to that discount too, right?
Yeah.
You mentioned the local cap rate is 8.6% against a 7.3% national average.
Right.
I want to push back on this for a second because, an 8.6 cap rate usually implies hair on the deal.
Sure.
It's the market's way of pricing in risk or uncertainty. So is CDA simply acting as a high-risk, high-yield discount aisle for investors getting squeezed out of primary markets, or is that 8.6% reflecting genuine, durable cash flow?
It's the latter, actually, and it's a really vital distinction for anyone deploying capital in this space.
Right.
In a traditional textbook scenario, yes, secondary and tertiary markets carry a risk premium, but what the data shows in CDA is a reflection of incredibly strong NOI potential relative to a very low entry price. Yeah, rents in CDA have grown significantly over the last few years, really closing the gap with larger regional hubs. But the asset values, like the literal bricks and dirt, haven't appreciated at the exact same velocity.
So you have big city rent growth colliding with small city acquisition costs.
Precisely. The 8.6% cap rate isn't an arbitrary risk penalty demanded by buyers. It's literally the mathematical output of a highly robust NOI paired with a $114 per square foot basis.
Right.
It makes it a highly lucrative, highly stable play for outside capital that is currently being starved of yield in primary markets where, cap rates have compressed to like 5 or 6%.
So if the yields are genuinely that strong and the supply side is that constrained, it completely recontextualizes who is actually transacting in this market.
Yes, it does.
Because if you're sitting in a boardroom in California or Texas looking at an 8.6 cap rate in a market with zero inbound supply, you don't really care that Coyote County is a secondary market. You just see the arbitrage.
Exactly. Which brings us to the most disruptive statistic in this entire Q2 report.
Let's hear it.
Over the past 12 months, a staggering 81% of buyers in this market were national. Meanwhile, 72% of the sellers were local.
Wait, 81% national buyers?
Yes.
And 72% local sellers. That's a massive transfer of regional wealth and control. Let's look at the year-to-date numbers on that.
Year-to-date, national buyers accounted for $7.4 million in transaction volume. Local buyers accounted for just $2.6 million.
We really need to dissect the psychology behind that split because those two groups are looking at the exact same market report but drawing wildly different conclusions.
Oh, completely.
The local owner is likely looking backward, right? They might have bought their building 10 or 15 years ago for $50 a foot. They see current valuations, they feel the fatigue of the current interest rate environment, and they decide it's a great time to take their chips off the table.
Yeah, they're anchoring their perspective to their historical gains, which honestly is a completely rational move for a private individual managing their own retirement or business pivot. But the institutional or national buyer is looking exclusively forward. They have a completely different investment horizon and a much more sophisticated view of replacement costs.
Right. The national buyer isn't comparing $114 a foot to what the building cost in 2010. They're comparing $114 a foot to what it would cost to build that same structure today, which we've already established is too expensive to even attempt.
Oh, yeah.
They see the construction cliff, and they know that in 36 months, the replacement cost of that asset is going to be astronomically higher.
And more importantly, they realize that whoever owns the existing inventory when the remaining 770,000 square feet of available space is gone essentially dictates the market terms.
Right. Monopoly power.
Basically, yeah. National Capital is incredibly efficient at spotting these structural imbalances. They are perfectly willing to pay local sellers what feels like a premium today, because they're buying future monopoly power over regional industrial rents.
But let's look at what they're actually buying. Because earlier you said the blended market average is $114 a square foot. But we know institutional capital isn't flying into CDA to buy 30-year-old metal sheds with gravel lots.
No, definitely not.
They have a very specific acquisition criteria.
And the transaction data proves that out beautifully. Over the trailing 12 months, the total sales volume for CDA Industrial hit $13.1 million.
Okay.
Now, for context, that is down significantly from the absolute peak of the market frenzy back in Q4 2021, when volume hit $17 million.
Right. Everybody remembers that peak.
Right. But it is a massive evolution from where this market was. Back in Q1 2018, sales volume was a mere $425,000.
Wow. Going from under $500,000 to consistent double-digit millions, that shows just how much this market has matured on the national radar.
It has completely transformed. Now, to address your point about what they are actually buying,
Good.
we need to zoom in on the logistics sector specifically.
Let's do it.
Year to date in 2026, there have been 10 completed logistics transactions totaling $1.3 million. But the average price per square foot on those closed deals is $196.49.
Wait, hold on. There's a huge discrepancy there. The blended market is supposedly valued at $114, but the actual deals clearing the market are closing at nearly $196 a square foot.
Yep.
That isn't a minor margin of error. That is two entirely different asset classes being lumped together.
It's the reality of how blended averages work and why investors really have to look deeper than the headline numbers.
Right.
That $114 per square foot includes the obsolete inventory, the older facilities with low clear heights, poor access, deferred maintenance.
The metal sheds.
Right. But national buyers are targeting premium, highly functional logistics spaces. They want the modern loading docks, the high ceilings, the ESFR sprinklers, and the immediate highway access.
They want the assets that are going to attract credit tenants, and they're willing to pay a heavy premium to secure them.
And honestly, even at 196 cents a foot, the historical context shows we're actually in a more rational pricing environment than we were a couple of years ago.
How so?
Well, in 2025, we saw 22 logistics deals close at an average of $208.81 per square foot. And in 2024, it was 9 deals at an incredible $348.50 per square foot.
Oh, wow. So the extreme froth of 2024 has evaporated, but the fundamentals for premium functional logistics space have stabilized at a very high plateau.
Exactly.
Which brings up a critical question regarding the capital markets. Buying Class A logistics assets at $200 a square foot in today's interest rate environment requires serious financial engineering. Who actually holds the keys to this market right now?
Well, if you look at the total asset value by owner type in CDA, the physical real estate is still heavily dominated by private owners, sitting at 69%.
Right.
After that, you have users, meaning owner-occupiers, holding 14%, institutional capital at 10%, and private equity holding 7%.
Okay, so private, largely local, and regional owners still hold the lion's share of the pie at 69%. But if 81% of the buyers right now are national, that means that 69% private slice is actively being carved up and shipped out of state with every closed deal.
And the reason national buyers are the ones able to execute these transactions comes down to the lending environment.
Right, the debt.
Yeah. To secure an asset at an 8.6% cap rate right now, lenders are being incredibly strict. Buyers are having to ensure their DSCR is incredibly tight.
Because the cost of debt is so high, there's just zero margin for error. You can't rely on a speculative pro forma.
Yep.
You can't acquire a vacant box and hope you lease it up in 6 months because the debt service will drown you before you get a tenant in the door.
Lenders require absolute certainty. They want to see reliable, existing NOI from day one. National buyers and institutional funds either have the cash to bypass traditional leverage entirely, or they have the portfolio strength to satisfy those stringent DSCR requirements that a local private buyer might really struggle to meet.
It's a compounding advantage.
Yeah, it really is.
The national players have the capital to buy the premium assets, which generate the reliable NOI, which satisfies the lenders, allowing them to buy more premium assets. You're describing the quiet, methodical institutionalization of a secondary market.
And it happens transaction by transaction. It doesn't make front page news when one 20,000 square foot logistics facility trades hands, but the cumulative effect over a 36-month period fundamentally alters who controls the physical infrastructure of the local economy.
Which perfectly sets up our outlook for the remainder of the year. We're heading into Q3 2026. Based on this data, what are the forward indicators that dictate the next phase of this market cycle?
Well, from a pure forecasting perspective, the model suggests that vacancy will hold incredibly steady at 6.9% through the end of the year.
Okay.
Barring a macroeconomic shock, the demand side of the equation is remarkably stable. But the definitive metric, the absolute canary in the coal mine for this market, remains that 48,000 square foot construction pipeline.
Because 6.9% vacancy feels like a comfortable equilibrium right now. But equilibrium requires a balance of forces.
Exactly.
If demand experiences even a slight uptick, say a couple of regional distributors decide they need to expand their KOTNE county footprint by 30,000 square feet each, that equilibrium just shatters.
It will aggressively compress the vacancy rate. And in an environment where no new buildings are slated for delivery to relieve that pressure, rents don't just experience standard annual escalations, they spike.
Right.
The leverage will be entirely consolidated in the hands of the owners who had the foresight and the capital to acquire these assets during this transition period.
So we have a market operating with a vanished construction pipeline, trading at a steep discount to the national average, generating robust 8.6% yields, and experiencing a massive influx of national capital, systematically acquiring the premium logistics inventory.
Yeah, that sums it up.
It is a textbook scenario of a market transforming under the surface.
It is fundamentally sound, but the entire ownership profile is shifting.
Which leaves us with a critical, lingering question to consider.
Right.
We started this deep dive talking about the friction between local and national players.
Right.
If local owners continue selling off 72% of the real estate to national buyers who are locking in those high yields, what happens in 3 or 4 years when this construction drought finally ends? Local businesses are going to wake up and realize they are no longer negotiating their leases with the local guy they've known for a decade.
Yeah.
They're going to be negotiating with out-of-state institutions whose primary mandate is algorithmic portfolio optimization. And those institutions will be holding all the cards.
That is the reality the data is pointing toward. And it's a dynamic every tenant and remaining local owner really needs to prepare for today.
Navigating a landscape shifting this aggressively requires precision. You have to know exactly where your current portfolio stands against these specific metrics. Thank you for joining us on this deep dive. As a reminder, to get a custom breakdown of how this data impacts your specific strategy and to map out your next move, you need to reach out to Eric Peterson at Activate Real Estate. Give him a call at 509-903-9077. Until next time, watch the pipeline and stay informed.